If you see what's been happening to equity markets recently, it seems as if they've been disconnected completely with the underlying economic reality. And the reason why it appears to be the case is because so far, equity markets have been pricing in a U shaped recovery. At WisdomTree, we believe in that U shaped recovery story for the global economy. But what happened yesterday was interesting. We know that Dr. Anthony Fauci in the US, the chief virus expert in the country, warned that an early end to the lockdown could create a second wave of the pandemic. Equally, some voices from the Fed have been warning about major bankruptcies in the US economy, and that sent jitters in the equity markets yesterday. So your question about the Fed continuing to send soothing voices is very important, and we can expect that to happen because until now the Fed has shown a lot of willingness to support the economy, to support markets, to do whatever it can to play its part.
I want to get to a new Goldman's note that came up because they're quite instrumental in calling some of the upside for markets on the S&P 500 with a target of about 3,000 points by year end. But we've seen a fresh note that's been issued by the head of the US equity strategist at Goldman's, effectively saying that now has a short-term target of 2,400 on the S&P, three-month target. That would be an 18% decline from where the stock market traded Friday session. And the issues he's raised has been around the amount of bank losses, $103 billion over the next few quarters, the lack of buybacks, dividends, and also domestic politics at play. These are factors that he believes have been underestimated by the market. What do you make of that?
Yeah, it's one thing to look at the headline numbers for major indices, and we've seen, S&P has recovered very strongly in the month of April after a sharp drawdown in March. But if you dig a bit deeper, you see that the story is not the same across all the sectors, and that's understandable because different sectors have had different impact from the current crisis. And you see that tech is actually leading the way. Tech was leading the way last year, and year to date, the story has continued. You see strong outperformance of the Nasdaq index to the S&P 500, and that's why it's important to pick which sectors are being impacted, and that really informs the view on the index level. And we expect that that tech story is likely to continue because tech is offering promising opportunities even during the crisis to not only survive but actually flourish for businesses. Look at all the solutions that are coming from the tech sector to communicate. At the current time, a lot of people are working from home. Tech is enabling that infrastructure. It's providing people with the infrastructure to work efficiently from home, for example, with cloud computing, with cyber security, all those things which are critical to keep that activity going. And that's why markets continue to bet on the tech sector to do well. And that's one of the main drivers for the equity markets.